Listen to me very carefully. While you were watching the latest tech earnings or arguing about the Fed's next move, something catastrophic broke in the global financial system last Tuesday. It didn't happen in New York. It didn't happen in London. It happened in Tokyo. And I'm not talking about a minor correction. I'm talking about a financial San Andreas fault line finally snapping. For the last 20 years, the Japanese government bond market, we call them JGBs, has been the most boring place on earth. It was the widowmaker trade, where nothing ever moved, yields were glued to the floor, and volatility went to die. It was the anchor that kept global borrowing costs low. Well, as of January 2026, the anchor is gone. In a single trading session last week, yields on Japanese debt spiked by 0.25 percentage point. Now, to the average person, that sounds like a nothing burger. But in the bond market? That is a nuclear detonation. It is a mathematical impossibility in a normal market. We are seeing standard deviation moves, events that statistically should happen once every million years, happening every other week. Why does this matter to you, sitting in Chicago, or Manchester, or Toronto? Why should you care about Prime Minister Sanae Takaichi or the Bank of Japan? Here is the cold, hard truth: Japan is the world's creditor. They hold $5 trillion of global assets. They own a massive chunk of America's debt. And right now, their house is on fire. If they decide to pull that $5 trillion back home to put out the fire, the S&P 500, the US housing market, and your pension fund are going to feel the heat. Today, we are peeling back the layers of the great Japanese bond crash of 2026. We're going to look at the Liz Truss moment brewing in Tokyo, the death of the carry trade, and why the US Treasury Secretary is making panic calls to Japan in the middle of the night. Buckle up. The era of cheap money is officially dead. To understand why this crash is terrifying Wall Street, we have to look at the before times. For most of the 21st century, Japan was the world's ATM. They had negative interest rates. You could borrow money in Japan for basically free. This created a dynamic where Japanese investors, who are notoriously conservative, looked at their domestic yields of 0% and said, no thanks. So, they took their money elsewhere. They bought US Treasuries. They bought French debt. They bought Australian real estate. They bought stocks on the NYSE. This outflow of Japanese cash acted like a subsidy for the rest of the world. It kept your mortgage rates lower than they should have been. It kept the US stock market liquidity flush. But the economic gravity in Japan has shifted violently. It started creeping up in 2024, but now, in early 2026, inflation in Japan isn't just a blip, it's a lifestyle. We are looking at core inflation over 3% for the fourth year in a row. The days of deflation are history. And when inflation rises, bond yields must rise to compensate investors. Enter Prime Minister Sanae Takaichi. She took over from Ishiba in October 2025 with a mandate that sounds very familiar to Western ears: massive fiscal stimulus. We're talking huge government spending and tax relief to help voters deal with the cost of living. But here is the problem: Japan already has the highest debt to GDP ratio in the G7. It's sitting at 230%. To put that in perspective, the US is around 120 to 130%, and we think that's bad. Japan is in a league of its own. When you combine high inflation with a prime minister who wants to print and spend money like it's 2020, the bond market vigilantes come out of the woodwork. They look at that debt pile, they look at the inflation, and they say, I am not lending you money at 1% anymore. I want 4%. And that is exactly what happened last week. The yield on the 40-year Japanese bond burst above 4%. The 30-year yield surged 75 basis points in just 3 months. Pramil Dhawan over at PIMCO, one of the biggest bond shops in the world, said we need to let that sink in. He's right. The market isn't just adjusting, it's breaking. We are seeing a complete repricing of risk in the world's third largest economy. And the scary part? This isn't rational trading anymore. It's emotional. It's panic. I want you to cast your mind back to the UK in 2022. Remember Liz Truss? She came in, announced a massive unfunded tax cut, and the British gilt market imploded overnight. The pound crashed, pension funds almost went insolvent, and she was out of office faster than a head of lettuce could rot. Wall Street is now whispering that Japan is facing its own Truss moment. You have a political leader, Takaichi, heading into a snap election on February 8th. She needs to buy votes, so she's promising looser budgets. Her rivals are promising the same thing. No one is talking about fiscal discipline. This disregard for the balance sheet is causing a credibility issue, to put it politely. To put it bluntly, the market is calling Japan's bluff. Ugo Lancioni from Neuberger Berman put it perfectly. He said the danger is that Japan was a market that never moved. It was a statue. Now, that statue is sprinting, and no one knows where the finish line is. But there is a key difference between the UK and Japan, and this is why you need to be worried. When the UK broke, it was a localized disaster. The Bank of England stepped in, the US watched from the sidelines, and it was contained. Japan is not the UK. Japan is the structural bedrock of the global financial system. The JGB market is worth over $7 trillion. If this market becomes disorderly, which is finance speak for untradeable chaos, it breaks models everywhere. We are already seeing the cracks. The liquidity is drying up. In the old days, domestic Japanese banks held all the bonds. They never sold. They just sat on them. But now, foreign investors account for roughly 65% of the monthly cash transactions in JGBs. That's up from 12% in 2009. Why does that matter? Because foreign investors are fickle. They are hot money. When they smell smoke, they don't grab a bucket, they run for the exit. Last Tuesday, it only took $170 million of trading in the 30-year bond to crash the price. $170 million. In a $7 trillion market, that is microscopic. It means there are no buyers. It means the floor has fallen out. This is what Arif Hussein from T. Rowe Price calls the financial San Andreas fault. We are getting tremors, and everyone is terrified of the big one. Okay, let's connect this to your wallet. Why does a bond yield in Tokyo affecting a teacher in Osaka matter to a software engineer in San Francisco? The answer lies in one word: repatriation. Japanese investors, banks, insurance companies, pension funds are sitting on a mountain of foreign assets. $5 trillion worth. For decades, they bought US Treasuries because US yields were 4% or 5% while Japanese yields were 0%. It was a no-brainer. But now? Look at the math. If a Japanese life insurer can get a 4% yield on a Japanese government bond, which is risk-free for them, denominated in their own currency, with no exchange rate risk, why on earth would they buy a US Treasury bond yielding 4.5%? The spread, the difference between the rates, is closing. The incentive to lend money to America is vanishing. We are already seeing the shift. Sumitomo Mitsui Financial Group, the second biggest lender in Japan, just dropped a bombshell. Their global markets head, Arihiro Nagata, said, "I always loved foreign bond investment, but not anymore. Now it's JGBs." That is a tectonic shift. If Sumitomo, Meiji Yasuda Life, and the Japan Post Bank stop buying US debt, who fills the void? The US government is running massive deficits. We need buyers. If the Japanese stop showing up to the auctions, the US Treasury has to offer higher interest rates to attract other buyers. Higher Treasury yields mean 1. Higher mortgage rates for you. 2. Higher auto loan rates. 3. Lower valuations for stocks. Goldman Sachs ran the numbers. They estimate that for every 10 basis point shock in Japan, US yields get pushed up by 2 to 3 basis points. That sounds small, but if Japan moves 100 basis points, that drags the US yield curve up with it. Anthony Doyle from Pinnacle Investment Management put it simply: that's how a Japan problem turns into higher US yields at exactly the wrong moment. And it is the wrong moment. The Trump administration is back in the White House, navigating a complex economic landscape. The last thing the US government needs is a spike in borrowing costs caused by a meltdown in Tokyo. This is why US Treasury Secretary Scott Bessent was on the phone with the Japanese finance minister, Satsuki Katayama, immediately after the crash. They aren't chatting about the weather. They are doing damage control. They know that if the Japanese bond market vomits, it gets on America's shoes. But wait, there's more. If the bond market crash wasn't enough, we have to talk about the currency, the yen. The yen is the heartbeat of the carry trade. Here is how the carry trade works: simply, hedge funds borrow yen because it's cheap. They convert that yen into dollars and go buy Nvidia, or Bitcoin, or high-yield corporate debt. It's free leverage. It's been the greatest money-making machine of the last decade. Mizuho Securities estimates there is $450 billion of yen funding this global casino. But this trade relies on one thing: the yen staying weak and Japanese rates staying low. Both of those assumptions are dying. As Japanese yields skyrocket, borrowing yen isn't cheap anymore. And if the BOJ steps in to stop the bond bleeding, they might have to hike rates even more or stop printing money, which strengthens the yen. When the yen shoots up, the carry trade blows up. We saw a preview of this in mid-2024. Remember that flash crash? The yen soared, and the S&P 500 tanked because funds had to sell their US stocks to pay back their yen loans. It wiped out $1.1 trillion in positions in days. Now, in 2026, the volatility is back with a vengeance. We are playing a game of whack-a-mole. Tuesday, bonds crash. Friday, BOJ Governor Ueda says he might buy bonds to stabilize yields. Result, the bond market calms down, but the yen crashes because printing money devalues the currency. Monday, the government panics about the weak yen and threatens intervention. The yen rallies. It is a volatility loop. They cannot fix the bond market without breaking the currency, and they cannot save the currency without crushing the bond market. The Fed knows this. That's why the Federal Reserve Bank of New York contacted financial institutions to ask about the yen's exchange rate last week. When the Fed calls you to ask, "Hey, what are you seeing in the yen?" that is a polite code for "we are terrified, please don't short this." It's a signal that coordinated intervention where the US and Japan work together to prop up the yen might be on the table. Why? Because the Trump administration views a disorderly Japan as a national security threat to the US economy. So, where do we go from here? We are hurtling toward the February 8th election in Japan, and the market is pricing in chaos. Based on the data and the expert consensus, here are the 3 scenarios you need to watch for. Scenario 1, the soft landing. PM Takaichi wins, but immediately pivots to fiscal responsibility. The Bank of Japan manages a masterclass in monetary policy, letting yields rise slowly to 4.5% or 5% without shocking the system. The Japanese repatriation of funds happens over 10 years, not 10 months. The US market absorbs the higher rates gradually. Why this is unlikely? Politics. Takaichi was elected on spending. Pivoting to austerity would be political suicide. Scenario 2, the slow bleed. Yields in Japan keep grinding higher. The 10-year JGB hits 3.5%. The carry trade slowly unwinds, creating a persistent headwind for US stocks. We don't get a crash, but we get a year where the S&P 500 struggles to make gains because liquidity is being sucked back to Tokyo. The wallet impact: your passive index funds underperform. Mortgage rates stay stubbornly high because foreign demand for US debt weakens. Scenario 3, the financial heart attack. The bond vigilantes break the BOJ. Yields spike uncontrollably, maybe hitting 5% or 6% in a matter of days. The yen collapses, forcing Japan to sell its US Treasury reserves to defend its currency. Note this quote from Anthony Doyle: if the yen slides hard, Japan has to defend it, and the fastest lever is selling reserves, including treasuries. If Japan dumping hundreds of billions of dollars of US Treasuries hits the market on a Tuesday afternoon, Wall Street crashes. Circuit breakers trip. This is the 2008-style liquidity crisis. Masayuki Koguchi from Mitsubishi UFJ Asset Management said it best: it's a new era. I don't think Japan's yields have gone far enough yet. This is just the beginning. For 20 years, we lived in a fantasy world of low inflation and free money, anchored by Japan. That world ended in January 2026. The implications of this are going to play out over the rest of the decade. We are watching the rewiring of global capital flows. The money that left Japan to fuel the growth of the Western world is coming home. As an investor, you cannot ignore this. The Japan story is no longer a niche topic for economists with elbow patches. It is the single biggest variable for the future of the US dollar and the US stock market this year. What should you do? 1. Watch the yen/dollar pair. If you see violent moves there, expect volatility in your stocks. 2. Keep an eye on the 10-year Treasury yield. If it starts spiking for no reason, the reason is Tokyo. 3. Diversify. If the liquidity tide is going out, the most speculative assets are usually the first to get left high and dry. The San Andreas Fault has slipped. The initial earthquake was last week. But the tsunami? That might just be getting started. If you found this analysis valuable, make sure you subscribe and turn on notifications. I'm going to be tracking the BOJ's moves daily because, frankly, my own portfolio depends on it. Let me know in the comments, do you think the US Fed will step in to bail out Japan's bond market, or are we on our own? Thanks for watching, and I'll see you in the next one.